Hey YouTube, hi friends, welcome back to the channel. In today's video we are going to discuss what is a diversified portfolio, why you should build one and how to build one, and why this is also called as an all-weather investment portfolio, meaning it will make you money in all weathers. Now I have a corporate job. I work at a very regular 9 to 5 job as a middle manager in one of the top biopharmaceutical companies, right? And in my free time I do investing, and my approach here to share the knowledge on this channel, which is basically for every common investor. It's not for ultra high net worth individuals. It's for people who are in corporate jobs who are managing anywhere between 1 to 10 crores, right? So an all-weather investment portfolio consists of three main things, and I will tell you exactly how I do it and what is the exact proportion in my portfolio, right? So first is equity, which is like stocks or mutual funds which have stocks, right? Second is debt, meaning this can be bonds or mutual funds which buy bonds, also called as debt mutual funds, right? And the third thing is gold, right? And gold, generally we buy not physical gold but paper gold, also called as ETFs, exchange traded funds, or gold mutual funds which buy gold bonds. So basically it will reflect the increase or decrease in the gold price. Now what you have to understand as an investor is that there's a very strategic reason why we have included these three asset classes in our portfolio. And the idea behind this portfolio is that even if you don't know anything about investing, you can blindly invest in this portfolio, right? Blindly, just close your eyes and dump all your money. If you have 1 lakh, just dump in this, and I will tell you in what proportion and when to change the proportions. When do I change the proportions? So what I'll be covering in this video is, first, now the asset classes where you have to invest in a diversified portfolio. Second, what proportion to keep in each asset class, and what funds to buy for each asset class. I will not name the funds, that you can decide yourself, but where to buy them, where to find them, right? So the important thing you have to understand is that stock market, or stocks, which basically consist of which are basically covered in equity, right, are kind of inversely correlated to gold. Now what does that mean? That basically means if it is gold price and this is stocks, whenever stocks go up, gold comes down, right? Or whenever stocks go down, right? I'll just remove this. Whenever stocks go down, gold goes up. Now this is broadly followed over history, but it is not exact. Sometimes it may not happen, sometimes it can happen to a higher extent, like exactly correlation. Sometimes it's very less correlation, but some correlation is there, inverse correlation is there, right? So that is why equity and gold hedge each other, meaning if equities are going down, gold goes up, so you don't lose a lot on your portfolio, right? So how we do this is by maintaining a certain portion of gold in our portfolio. So generally I personally keep 50% in my all-weather portfolio, 50% equity and 20% gold, right? And 30% is debt. Now what debt does is, debt, irrespective of whatever market condition, it will give you anywhere between 5 to 9% returns on your portfolio, depending on the kind of asset and some RBI guidelines at that time during the year, right? So it provides a kind of a balance to your portfolio, meaning your portfolio will not go drastically up and down, and this will balance it. But again, you have to, over the long term, equity does well generally, it has been seen, and since India is a growing economy, so it will do well at 12 to 14% returns. So you'll lose a little bit on the returns, but it will provide a balance and stability to your portfolio, and as a result you'll not take any irrational decisions at all times. Your portfolio will not be drastically red, mostly it will be green, and even if it is red, meaning you're making losses, it will be very minor losses, and you'll recover as soon as the equity markets recover, right? So this is a very simple pie we have created. So we are buying 50% equity, we are buying 30% debt, and we are buying 20% gold in our all-weather diversified portfolio. Now, why do I say this? That you can now, after having seen this, you can invest in this blindly, and I'll show you why. So generally, equity has over the last few years has given us a return of 14%, 12 to 14%. Nominal GDP, meaning adjusted to, not adjusted to inflation. If you adjust it to inflation, it is around around 8 to 10%, right? So the maximum returns you will be getting will be from your equity share, but over the long term, equity does not go straight, it goes up and down, but over the long run it goes up, right? So that is why you maintain 50% equities, to ensure that you make wealth in the long run, right? Debt will give you anywhere, as I said, between 6 to 9%. Gold will give you, over time we have seen, 8 to 10% returns, right? So we keep this mix in our portfolio, and it's very easy. So what I would, there are many ways to do this, right? So again, I'll write here equity, gold and debt, but I'll tell you how I do it in the simplest way. So when you're buying equity, you can buy individual stocks, you can buy ETFs of some themes. For example, Nifty 50 is a basket of top 50 stocks of India. You can buy Nifty 50 ETF, exchange traded fund. What it basically does, it basically replicates Nifty 50, and it is traded on stock exchange. So you can buy one unit of ETF just like any stock, right? Or you can buy mutual funds, which are again basket of stocks, but it is again equity, right? Basket of stocks. It can be basket based on different themes, etc. And also you can buy index funds, meaning an index fund is also a mutual fund which invest in any index. For example, Nifty 50 index fund. What is the difference between an index fund and a mutual fund? Here the difference is in the expense ratio, which is the management fees. So when a fund manager is taking your money and investing in any mutual fund, where he's using his expertise, he will charge you a fees which is called as the expense ratio. Okay, expense ratio, and this can be anywhere between 0.5 to 1.5% for mutual funds, and for index funds it is very less, 0.005%, which is basically very less, because here it is passive investing. Here it does not have to do any hard work, while for mutual funds he has to select, he has to do research, equity research, he has to hire analysts, etc. So they charge more, right? So we have all these options to invest our 50% money in equity. So let's say you have 1 lakh rupees, you have to invest 50,000 in this asset class. You can choose your stocks. You can either buy ETFs of Nifty 50, and again here I'll mention that ETFs and index mutual funds are also basically same. You can get the ETFs of the same index where the index mutual fund is also offering, and expense ratio in ETFs is even lower than index mutual funds. But here the thing is about the volatility. So if let's say your portfolio increases and you have let's say 50 crores of money to manage. Now 50 crores of ETF, if you want to liquidate, you would want to sell, but it's not necessary that a buyer is available all the time. So there's a liquidity issue. Well, in case of an index mutual fund, you just have to tell your mutual fund owner, and since he is managing a corpus, a very big corpus of other investors, so fund is like 1000 crores, so he will easily be able to give you 50 crores the very next day or in a couple of days according to the settlement period. Okay, so this is the difference between index mutual funds and ETFs. Now for the beginners, I would highly recommend to go with a combination of mutual funds and index mutual funds. Do not go with ETFs, do not go with anything else. Do 50-50 mutual funds and index funds. Then I will cover in my next video what all mutual funds to invest in, right? For example, large cap, mid cap and small cap. But do 50-50. 15 index fund, 15 FT50 and 50 in mutual funds, and right. And but if you are a seasoned investor, you can then divide your 50% into again like 10% of this 50% you'll invest in stocks, 20 you can divide into index funds, and 20 into mutual funds. Simple as that. Don't complicate this. Okay, now coming to gold. So where do I buy gold? I buy gold ETFs. Again, gold is available as ETF. So what an ETF basically will do, it will track the prices of gold. So physical gold, whenever the price is increasing or decreasing, it will reflect in the price of this ETF. So if let's say in the physical gold your return over a year is 6%, the ETF return will also be 6 to 7%, right? So it very closely replicates, and this is called as tracking, right? Likewise in debt, so in gold I buy both ETFs as well as gold mutual funds. So gold mutual funds are also available, which again track the very same thing. So you'll get these returns exactly or very similar to the actual increase or decrease in the gold prices. So yeah, so you can buy either gold mutual funds or gold ETFs. I buy both, but now mostly I'm buying gold mutual funds because it's like a no-brainer for me. Likewise in debt, there are then options in debt. You can buy debt mutual funds, and debt mutual funds are mainly of three types: liquid funds, short-term duration funds, and gilt funds, right? So these funds are basically named and categorized based on the maturity of the underlying bonds they're buying. So short-term funds are very short-term, so like bonds are maturing within 1 to 3 months, while short duration funds like 3 to 6 months, and gilt funds are long maturity funds. So in the short liquid funds, the rates are less, while in short-term funds the rate of return is a little more, while in gilt funds it is the maximum around 7 to 9%. Here it is 5 to 6%, here it is 6 to 7% almost. So not very high returns, but decent returns compared to FTs, right? Now here again I keep a mix. So money which I know I will never use, I keep in gilt funds, right? So let's say I'm investing 30% of my money in debt fund for that year, 30,000 rupees, and I'm very sure that 10,000 I will never use, right? So I will put 10,000 in gilt funds and let it compound over time. Remaining 20 I divide, which I might need in a time at any time for covering my expenses or for buying equity positions when the market is cheap. So this is how I divide, right? And I will again make a detailed video on debt mutual funds, what they are, how to buy them. But in this video I just wanted to cover the overall division. So here 50%, gold 20%, and debt is gold. Debt is 30%, right? Now what will happen whenever if you have a diversified portfolio, if you're not keeping your eggs in one basket, you're keeping your eggs in multiple baskets. Whenever there's a shake in the market, whenever there's a corona, or whenever there is a Trump doing bizarre things and market goes down, your portfolio will be like this, market will be like this, but your overall portfolio will be like stable. And when the market goes up, it will be again going up, not at the highest rate because you have debt and gold, but like this. So you'll get an average return with stability, right? You'll get a good return which is stable. It will not be like this like market, and you'll not get any heart attacks, right? And returns would be good. It will be good for compounding your wealth, 10 to 12% in this proportion. Now, one additional thing what I do is whenever the market is expensive, so we have a way of figuring out when the market is expensive. For example, when the market has broken its higher top, highest high, and it is trading at P multiples of more than 25, then it is expensive. At that time, it doesn't make sense to invest in equity. So instead of 50% equity division, you make it like 30% or 20%, right? And this remaining 20-30% you park in your liquid funds, which you might need after 3 months to invest in back into the equity markets. So depending on the market is cheap or expensive, you take these positions, right? So I'll cover much more of this in my upcoming videos in detail, but for this video I just wanted to cover this. I hope you liked it. If you did like it, do get a thumbs up. Do subscribe to the channel if you're new here, and I will see you again in my next video. Till then, take care, bye bye, and I will see you again soon. Thanks for watching.